Merton Miller, a Nobel Prize-winning economist, when asked to summarize his work in modern portfolio theory, said, "Diversification is your friend." I'll add a corollary that oftentimes the media is not your friend as an investor. Diversification certainly was our friend in 2013. If you look at this chart, it shows asset classes that are included in all Savant portfolios, including ones that disappointed in 2013, like commodities and Treasury inflation-protected securities, or TIPS. Emerging markets were a disappointment in 2013, but you had other asset classes, namely developed markets, small and large companies in developed markets and small and large companies in the United States, that really helped buoy returns in 2013 so that we were able to achieve a very good year indeed. What this chart does is it ranks the asset classes in order of their performance, best on top being US small cap stocks, 38.8%, to leading out the bottom, a negative 9.5% return for commodities. And we ranked all the asset classes in order from best to worst. Remember those colors for a moment, because we're going to take a little look further back than 2013 into what happened, going all the way back to 2004. Now, some of you in the far back may have trouble discerning the pattern here of returns year over year. So I'm just going to take a moment so you can squint, get a good look here. Can you discern the pattern? You guessed it. The pattern is there is not a pattern. Markets continually surprise us and teach us to expect the unexpected. So which asset class should you have going forward? Well, you won't be surprised to learn that the answer is you should remain diversified and have a diversified basket, a global basket of stocks and bonds. This is the prudent move for investors in an uncertain future. Going back a little bit further than 2013, some of you may have noticed or heard in the media that we marked, I will not use the term celebrated, the 5-year anniversary of the bottom of the bear market in March of 2009. This takes us back 5 years and shows the returns of portfolios from 20% equity all the way up to 100 in your diversified Savant portfolios, and compares it to the global equity index, which had a return of 15.6% during that 5-year window. That's an average annual return. And bonds had a 4% average annual return. If you think back to 2009, and if you told anyone that global equities were going to have a return of 15.6%, you may have gotten a funny look. I know I got some of those looks back in 2009. But truly, for diversified, disciplined investors, their patience paid off during that 5-year window. 10-year returns for the Savant models going from 20% equity all the way up to 100. An all-equity investor over that 10-year period of time, even including the bear market in 2008 and 2009, had a return of just shy of 8%, 7.9%, compared to the global equity index of 7.6% and the bond index return of 4.1%. A more typical Savant client with 70% equities had a return, on average return, just shy of 7%. And even if you had as little as 20% in equities over that period of time, you had a return in excess of 4%. Predicting the future is difficult. That's why I'm going to turn over the keys here in a moment to Brent to talk about the future. But the good news, and what 2013 taught us yet again, is predicting the future is largely unnecessary in order to capture capital market returns over time. What's important is that we be disciplined, diversified, and that we maintain faith, patience, and discipline.